Disclaimer, this video is for educational and informational purposes only. The content shared does not constitute financial investment or trading advice.
Right now, at this very moment, the same ounce of silver is trading at 3 different prices across 3 different continents. Not 3 slightly different prices, 3 meaningfully different prices. And the gaps between them are widening in ways that suggest the global silver market is fragmenting into regional pricing zones that no longer behave like a unified arbitraged system. When that happens in any commodity market, it tells you something profound is happening underneath. And for silver, what's happening is the most important structural shift in how the metal is priced and traded in decades. Today, I'm going to break down the 3 exchange problem: why Comex in New York, Shanghai Futures in China, and the London Bullion Market are no longer singing the same tune. What's causing the divergence? What it reveals about where real physical demand actually sits globally. And most importantly, what it means if you own silver or you're thinking about owning it. Stay with me on this one because this is the story nobody on mainstream financial media is equipped to explain. Let's start with a question that most people never ask because they assume the answer is obvious. Why are there 3 major pricing centers for silver instead of 1? If this is a global market, if silver is a fungible commodity that moves freely across borders, why isn't there one global price? The short answer is history. The long answer is that silver pricing evolved along regional lines, and those lines have calcified into regulatory, institutional, and trading infrastructure that doesn't just disappear when markets become more connected. Comex, the commodity exchange in New York, that's the Chicago Mercantile Exchange's precious metals division, became the dominant global pricing center for silver by accident and by evolution. After World War II, as the United States emerged as the economic superpower and the dollar became the global reserve currency, New York became the financial center of the world. Comex grew up around that gravitational pull. By the 1980s and 1990s, Comex had such massive trading volume and such deep liquidity that it became the reference price for silver globally. When someone says the silver price, they mean the Comex spot price. It's quoted on Bloomberg, CNBC, your brokerage platform. For decades, that was the only silver price that mattered. The rest of the world priced silver relative to Comex. But China didn't stay passive forever. As China's economic power grew, as its industrial consumption of silver exploded, China built its own pricing mechanism. The Shanghai Futures Exchange, the SHFE, established its silver contract in the early 2000s and gradually built it into a major trading center. The Shanghai Gold Exchange, the SGE, handles physical delivery. Together, these 2 institutions created a Chinese pricing apparatus that operates in yuan, reflects Chinese supply and demand, and is subject to Chinese regulatory oversight. It's parallel pricing infrastructure. Then there's London. The London Bullion Market, or LBMA, that's older than both of them, it goes back centuries. It's the epicenter of over-the-counter precious metals trading, the market where central banks, sovereign wealth funds, and major institutional players trade unimaginable quantities of physical metal outside of futures exchanges. When you hear about the London Fix, that's the LBMA. It's not a futures exchange. It's a physical market, a wholesale market. But it sets a price, and that price matters enormously for institutional players globally. So you have 3 distinct mechanisms for pricing silver, 3 different geographies, 3 different regulatory regimes, 3 different participant bases. For years, they stayed roughly in alignment because arbitrage traders would buy on the cheaper exchange and sell on the more expensive one, closing the gap. That arbitrage worked because silver could move freely. Shipping costs were predictable, import duties were manageable, and the gaps between the prices were small enough that traders could profit from the spread. But here's what's been happening. Those gaps are no longer small. They're not closing efficiently anymore. And the direction of the divergence is telling us that the regional pricing mechanisms are reflecting fundamentally different supply and demand pictures. Let me show you what I mean with actual numbers. Let's say Comex is trading silver at $28 per ounce. That's our baseline. When you convert the Shanghai futures price from yuan per kilogram into dollars per troy ounce, adjust for the currency exchange rate, and account for the normal shipping and import costs, you should land somewhere between $28 and $29. Maybe 29.50 at the high end, depending on the day and the exact logistics. That's the spread that arbitrage can close easily. But what we've been seeing is Shanghai coming in between $30 and $32 per ounce, often higher. That's not a shipping cost. That's not a currency fluctuation. That's a structural premium that persists. Now look at London. The London Bullion Market, because it's an over-the-counter market without a published futures contract, the pricing is less transparent. But wire services and data providers track the LBMA silver price daily. And what we're seeing is London trading in a band that's closer to Comex than to Shanghai, but not perfectly in line with either. London tends to be somewhere in the middle, but it's moving in ways that suggest it's being pulled more toward Shanghai's premium than toward Comex's lower price. So the 3 exchange problem is not just that prices differ. It's that the direction of the divergence, the structural nature of it, and the fact that it's not closing tells you the markets are decoupling. And when markets decouple, it's because the underlying supply and demand pictures are different. Let's dig into why. Start with Comex. Comex is a futures exchange. It's not primarily a physical market. Yes, there are Comex vaults that hold silver, and yes, futures contracts can settle in physical delivery. But the vast majority of trading, somewhere north of 95%, settles in cash or rolls into the next contract month. The metal never moves. Comex is a price discovery mechanism that operates largely on paper. The price that emerges from Comex trading reflects the collective betting of futures traders, hedge funds, spec money, and commercials on where they think silver is going. It reflects sentiment, momentum, technicals. It's a real price, it matters, but it's not primarily driven by physical supply and demand. At the point of trade, it's driven by positioning. Now, flip to Shanghai. The Shanghai Futures Exchange has different characteristics. Yes, it also trades futures, but the participant base is weighted differently. Shanghai sees more direct participation from Chinese industrial consumers. Solar panel manufacturers, electronics makers, battery producers, they participate directly or through their trading desks. They're not speculating on where silver goes. They're hedging their input costs. They need the metal or they need to lock in prices. That changes the dynamics of the market. Additionally, the Shanghai Gold Exchange, the SGE, the physical delivery mechanism, is tightly integrated with a futures exchange. When Chinese industrial buyers need metal, they can take delivery through these integrated channels quickly and efficiently. The price on Shanghai reflects not just speculation, but actual physical demand and actual physical supply constraints inside China. When Chinese solar manufacturers are competing for silver and bidding prices up, Shanghai prices reflect that in real time. London is different again. The LBMA is a wholesale over-the-counter market. It's where bullion banks, central banks, major institutional players trade physical metal in massive quantities. The price on LBMA reflects the cost of actually acquiring and delivering physical silver in the London vaults. It's a physical market, but it's also a global market where the participants are sophisticated enough to arbitrage across exchanges, so it tends to sit somewhere in between. That's the setup. 3 different market structures, 3 different participant bases, 3 different primary drivers. Now here's where it gets interesting. For most of the last 2 decades, these 3 exchanges stayed in alignment because the barriers to arbitrage were low. If Shanghai premium got too high, traders bought on Comex, shipped to Shanghai, sold the premium, and pocketed the profit. That flow closed the gap. But that arbitrage trade has become harder to execute at scale. Why? Several reasons. First, there are regulatory barriers. China has strict capital controls. Getting money in and out of China is not as simple as wiring funds. There are quotas. There are approvals required. For a large arbitrage operation, shipping millions of ounces of physical silver and financing that operation through Chinese channels is not simple. The regulatory friction is real. Second, there are logistical constraints. Getting silver from a Comex vault in the United States to a SHFE-approved vault in Shanghai takes time. There's shipping time, there's documentation, there's customs clearance on both ends. And here's the thing that most people don't think about. The silver has to be in a form that's acceptable to the receiving exchange. Comex deliverable silver has to meet certain purity and bar specifications. Shanghai has its own specifications. Sometimes the bars meet both. Sometimes they have to be recast. That adds cost and time. Third, the availability of silver on Comex that can actually be moved is constrained. Remember, there's a distinction between registered and eligible silver. Registered silver is warranted for delivery against futures contracts. Eligible silver is in the vault but not actively available. But here's the deeper issue. Much of the silver in Comex vaults belongs to someone. It might be in a vault, but it's not for sale. It belongs to an ETF, or a fund, or a sovereign entity, or someone else who's holding it as a reserve. That metal is not available for arbitrage traders to acquire and move. So the headline number, hundreds of millions of ounces in Comex warehouses, doesn't mean there's hundreds of millions of ounces available to arbitrage. Fourth, there's the sheer scale of Chinese demand right now. Even if arbitrage traders could move metal efficiently, the volume of demand from China is so large and so continuous that arbitrage can't keep up. The demand for physical silver inside China is structural. It's not a trade. It's industrial consumption. It's investment demand from Chinese retail and institutional buyers. It's central bank considerations. That demand is bigger than the arbitrage flows can satisfy. So Shanghai stays at a premium. Here's what this means. The 3 exchange problem is telling us that the global silver market is no longer unified. It's regionalizing. Shanghai is pricing silver for Chinese demand and Chinese supply constraints. Comex is pricing silver for Western sentiment and positioning. London is trying to connect the two, but is increasingly influenced by what's happening on the edges. When that happens, when major commodity markets regionalize, it's usually a sign that something fundamental has shifted. In silver's case, what's shifted is that China's demand is now so large that it's creating its own price discovery mechanism. China's demand is no longer being satisfied by the Comex price. Chinese buyers are bidding higher, and they're moving physical metal to satisfy that demand. The arbitrage isn't closing the gap because the gap isn't being driven by temporary mispricings. It's being driven by structural supply shortage relative to demand in the region. Let me connect this to what's actually happening on the ground. China's solar industry alone consumes over 200 million ounces of silver per year, and that number is growing. China's electronics industry, its EV infrastructure, its 5G deployment, all of that is silver intensive, and it's all growing. That demand has to come from somewhere. Some of it comes from recycling, some of it comes from Chinese domestic production, but increasingly, it has to come from imports or from drawing down global inventories. When that flow gets interrupted, when there's not enough silver to move freely to Shanghai at the Comex price, Shanghai buyers bid up the price locally. That's exactly what we're seeing. Now, the London Bullion Market sits in the middle of this. London is where much of the institutional global silver actually changes hands. It's where refineries sell metal, where central banks buy and sell, where the real physical flows happen. The LBMA price is influenced by both what's happening in New York and what's happening in Shanghai. But increasingly, it's being pulled toward Shanghai's premium because that's where the real physical demand is. Here's what happens next in a three-exchange market that's fragmenting. The Western price on Comex gets further and further disconnected from the physical reality that both Shanghai and London are pricing in. Comex traders are trading financial instruments backed by a promise that metal exists. But Shanghai traders and London traders are dealing with actual physical constraints. That gap has historically resolved one way. The financial price eventually reconciles with the physical price, and when it does, it reconciles upward. Now let me address the risks because there are real risks. First risk, a sudden change in Chinese policy. If Beijing decides that the silver fund premiums have gotten out of hand, they could open new arbitrage channels, allow more silver-backed products, increase the supply of silver available domestically. That would cool the Shanghai premium rapidly. The arbitrage would start working again, and Shanghai would trade much closer to Comex. That's a real risk for anyone betting on a sustained Shanghai premium. Second risk, a global liquidity crisis. In a financial panic, silver, like most assets, tends to sell off as investors liquidate to raise cash. During those episodes, even the regional pricing mechanisms tend to converge as everyone hits the bid at the same time. The divergence would close, but it would close downward, not upward. Third risk, a strengthening dollar. If the Federal Reserve holds rates higher for longer and the dollar strengthens, that puts downward pressure on silver prices denominated in dollars. That could reduce the Shanghai premium if it makes imports from Comex less attractive from a return perspective. But underneath all those risks, the base case is clear. The three-exchange problem exists because China's demand is too large to be satisfied by the Comex price. Shanghai has its own structural demand that's not being met at the Western price levels. London is the bridge between them, and the gaps between these three prices are telling you that the global silver market is tightening. What should you do with this information? First, understand that Comex price is no longer the whole story. It's one piece of a three-part puzzle. If you're tracking silver for investment purposes, you need to be watching all three prices. Second, the persistence of the Shanghai premium tells you that physical demand is real and structural in China. That's bullish for the price trajectory over time. Third, if you own silver, the regional fragmentation is actually supportive of higher prices because it means demand is outpacing supply in the biggest industrial consumer on the planet. Here's what to monitor going forward. Watch the Comex Shanghai spread weekly. When it widens, it means the regional imbalance is intensifying. When it narrows, it might mean either arbitrage is flowing or Chinese demand has eased, both of which would be significant signals. Watch the LBMA price relative to both. If LBMA starts trading consistently closer to Shanghai than to Comex, it means institutional players are pricing in the Chinese dynamic as a permanent feature of the market. Watch Chinese silver import data. If imports are growing faster than the Shanghai premium can explain, it means demand is even stronger than the premium suggests. Watch the gold-silver ratio in all three markets. If all three prices are moving together, it means they're still somewhat unified. If they're moving at different speeds, it means the fragmentation is deepening. The three-exchange problem isn't a glitch. It's a market structure telling you that silver demand in the world's largest industrial consumer has decoupled from Western pricing mechanisms. It's telling you that physical supply is constrained. It's telling you that the gaps between what Comex thinks silver is worth and what Shanghai thinks silver is worth are structural, not temporary. When major commodity markets fragment along regional lines, it typically precedes a significant repricing. That repricing usually goes in the direction of the strongest demand center. In silver's case, that's China. So the three prices that are currently diverging are likely to converge, but not by Shanghai coming down. By Comex and London coming up. If you've made it this far in the video, you understand something that most Western investors and traders miss entirely. Silver pricing is no longer a three-way tie. It's a three-way tug of war. And the strongest hand is in Asia. Stay positioned accordingly. Thanks for watching. Hit subscribe if this analysis made you think differently about the silver market. I'll keep tracking how this story develops. See you in the next one.